Imagine looking at the medical x-ray of an elite marathon runner. On the outside, they just broke a world record.
Right, they look totally unstoppable.
Exactly. But if you look really closely at that internal scan, you realize their circulatory system is quietly collapsing.
Wow, yeah.
The heart is struggling, the arteries are clogged, and the entire system is, on the verge of shutting down.
It's a terrifying disconnect.
It really is. That disconnect between outward performance and internal health, that is exactly what the global financial system looks like today.
Yeah, I mean, it is the absolute definition of diagnostic muddy waters. The warning signals are flashing bright red, but they're buried under a lot of superficial green lights that just keep everyone feeling safe.
And breaking through that false sense of security is basically our mission for this deep dive. We are cutting through the daily financial noise to uncover this massive structural shift happening right under our noses.
Specifically in the monetary metals market.
Yes, exactly. And our insights today come from a really compelling breakdown by Michael Oliver. It was featured on the YouTube channel The Bullion Brief, and the video is titled, "Most Investors Still Don't See What's Coming for Silver."
It's a fascinating piece of analysis, honestly.
It is.
Primarily because it forces you to look past the daily ticker tape and, actually examine the foundation. It challenges that whole consensus narrative that everything is fine just because the broader stock market is up.
Right. Okay, let's unpack this because whether you are actively managing a retirement portfolio or you're just trying to figure out how to protect your savings from evaporating, understanding these under-the-radar economic signals is a massive shortcut.
A shortcut to staying ahead of the curve, yeah.
Exactly. You do not want to be the person who only realizes the weather has changed when you're already caught in the hurricane. So let's start with the surface level.
The S&P 500.
Right. The S&P 500 has been making these triumphant new highs. Everyone is cheering. But Oliver points out that if you look at the financial sector represented by the XLF Exchange Traded Fund, which covers big banks, broker-dealers, insurance companies, it's acting like a complete dud.
A total dud. And, I mean, we can get even more granular with the data here.
Oh, please do.
Look at the KBE. That's the ETF specifically tracking large banks, excluding the smaller regional ones. If you go back 4 years to 2022, the price of that bank ETF is only up about 5%.
Wait, 5%? In 4 years?
5% in 4 years. During a period where the broader market has been absolutely roaring, the institutions that are actually handling the money are essentially flatlining.
Which feels completely counterintuitive, and the source highlights a specific metric that makes this even more alarming, right? The spread relationship.
Yeah, the ratio between the two.
Right, so if you divide the XLF financial sector by the S&P 500 to see how they're performing relative to each other, the financial sector's relative performance is just collapsing. It is falling through a multi-year floor.
Which is wild.
It is. And the last time we saw this exact divergence where the broader market was making all-time highs but the financial sector was silently tanking was October 2007.
And if we connect this to the bigger picture, shifts in the financial sector rarely attract mainstream attention.
No, never.
Right now, the media cycle is entirely dominated by flashy headlines. Everyone is looking at artificial intelligence, semiconductor valuations, big tech earnings.
NVIDIA, all of that.
Exactly. But the banking sector isn't just another industry. To use your marathon runner analogy, the financial sector is the circulatory system.
Yes. The S&P 500 is the outward appearance of the runner. They look perfectly healthy on the outside. But if their circulatory system, the banks that are responsible for pumping lending and liquidity throughout the limbs of the economy, if that is sluggish and failing, you can't just slap a Band-Aid on it.
No, you really can't.
You cannot have a healthy body with a failing heart.
The banks are the ultimate tell. I mean, if the institutions responsible for generating liquidity are struggling to keep pace with the rest of the market, it reflects deep systemic stress developing behind the scenes.
Like credit conditions tightening.
Exactly. It means credit conditions are quietly tightening,
Yeah.
or there's declining confidence within the financial system itself. But here's the crucial distinction. While the warning signs look identical to 2007, the underlying disease is entirely different this time.
Okay, now my memory of 2007 is that it was all about toxic mortgages, people getting loans they couldn't afford and the banks packaging them up. So are we looking at another real estate collapse?
No.
Yeah.
And that is a critical misunderstanding a lot of investors have right now.
Oh, really?
Yeah, they're preparing for the last war. The rot today isn't in residential real estate, it's in sovereign debt, government bonds.
Ah,
We are looking at a fundamentally different root cause. which requires a completely different defensive posture from anyone trying to protect their assets.
And that leads us to the core issue Oliver outlines, which is the decay of fiat currency and this looming sovereign debt crisis. The source mentions Jamie Dimon recently warning about a government bond crisis.
Yeah, and it isn't just isolated to the U.S. either.
Right. You look at Japan, they're facing staggering sovereign debt issues. The Japanese prime minister essentially signaled that they have to, quote-unquote, print to save their bonds, which mechanically sounds a lot like what happened here in 2008.
Well, it's the exact same playbook, just on a much, much larger scale. When government debt reaches these historic highs, central banks are put in a terrible predicament.
Because they have to defend the government bond market.
Exactly. If sovereign bonds fail, the foundational collateral of the entire global financial system just collapses. So how do they defend it? They step in as the buyer of last resort.
Right.
And how do they buy those bonds? They literally create new currency out of thin air to make the purchase.
So when they do that, they expand the M2 money supply. The source actually calls the current M2 chart a vertical bull market.
Yeah, it's just straight up.
Straight up. But help me understand the actual mechanism here. How does expanding the money supply create this illusion of wealth that traps so many everyday investors?
It comes down to understanding the difference between value and price. We constantly misdiagnose inflation.
How so?
Well, when central banks flood the system with new currency, those dollars, yen, or euros have to go somewhere. They flow into assets, stocks, real estate, commodities.
Okay.
So the price tag on everything goes up. But the human psychological response is to look at a rising stock portfolio or a rising home price and say, wow, my assets are generating incredible wealth.
Because the number on the screen is higher.
Precisely.
Uh-huh.
But in reality, the asset hasn't intrinsically changed. The company isn't necessarily producing more value. The house is still just the same wood, concrete, and pipes providing the exact same shelter.
Yeah. Right.
Right.
What has actually happened is that the currency used to measure the asset has been debased. It takes more of these diluted dollars to buy the exact same thing.
But the currency is getting cheaper, not the asset getting more valuable.
Exactly. The source brings up a great example. A granddad built a house for $4,500. A dad bought it for $45,000. And today the median is $450,000. It's just currency decay.
Okay, I have to push back here, because there is a very common assumption in the financial world that feels completely contradictory to this.
Let's hear it.
The conventional wisdom is that when inflation runs hot, the Federal Reserve raises interest rates to fight it. And everyone says that high interest rates crush precious metals like gold. Because why would you hold a shiny rock that pays zero yield when you can get a risk-free 5% in a savings account?
Right, that's the classic textbook argument.
So if inflation is hot and rates go up, shouldn't gold get absolutely hammered?
It is a very common narrative, but the historical data from the source completely debunks it.
Yeah. Let's look at the ultimate inflationary period in modern U.S. history, 1974 to 1980.
Okay.
The Fed was raising short-term rates aggressively. I mean, they pushed them to 14%. 30-year bond yields jumped from 7.5% to 12.5%. Based on the conventional textbook wisdom you just mentioned, gold should have been obliterated.
But I'm guessing it wasn't.
It exploded. Gold had an unprecedented historic run during that exact same period of aggressively rising rates.
Wow. Why?
Because the market realized that even at 14%, the interest rate was still trailing the actual real-world rate of currency decay. The yield wasn't enough to compensate for the loss of purchasing power.
Oh, that makes sense.
Yeah, the Fed's dual mandate fighting inflation and maintaining employment is, frankly, a bit of a distraction. Their unwritten primary mandate is defending the government bond market.
And when they have to print currency to do that, hard assets like precious metals historically sniff that out and reprice themselves accordingly. So, if fiat currency is actively decaying, and gold has proven it can hold its value through these cycles, this brings us to the start of the show. Silver.
Yes, silver.
Because Oliver points out a widespread misconception. Most people, and even most Wall Street analysts, treat silver purely as an industrial commodity. They think about it going into solar panels, electric vehicles, medical devices.
And it does. I mean, it has an undeniably robust industrial demand profile. But that is only half the story.
Right, but since last November, the data shows silver broke out relative to gold. When you plot a spread chart of the two, silver broke out of a 10-year range.
It's proving that, at its core, it still moves with the monetary metals.
It is acting like money. But the craziest part of this analysis is the historical context of silver's price confinement. We are talking about a 50-year ceiling.
Yeah, half a century.
Silver has been stuck in basically a $50 range for 50 years. That is wild.
What's fascinating here is when an asset is suppressed for that long, the eventual breakout is never gradual. Oliver brings up incredible historical precedents to illustrate the mechanics of what happens when a major metal finally breaks a multi-decade ceiling.
Oh, right, like copper.
Exactly. He points to copper.
Yeah.
Copper was stuck trading between 50 cents and $1.50 for decades. Then, in late 2005, the pressure finally overwhelmed the range.
And it didn't just drift up to $2.
No. It quadrupled in a few quarters. It blew past $4.10 and is now sitting over $6.
Unbelievable.
And led to the exact same thing in 2010. It had been asleep in a tight range of $5 to $55 for decades. When it finally broke out within a few quarters, it quadrupled too.
Wow.
It established an entirely new reality, completely under the radar. There were no front-page headlines about lead, but the underlying cost of industrial production changed forever.
Wait, I need to understand the mechanism here. How does a globally traded asset like silver just stay stuck for 50 years while the currency around it is continuously decaying? Who or what is keeping it in that box?
That is the multi-trillion-dollar question. It comes down to the mechanics of the paper futures market versus the physical market.
Okay.
For decades, the price of silver has largely been dictated by paper contracts traded on exchanges, rather than the exchange of physical, tangible metal.
Right.
Because you can theoretically create an infinite number of paper contracts, financial institutions can suppress the price by flooding the market with paper supply whenever physical demand spikes.
I see. So it's like a pressure valve. The core heat of inflation and industrial demand is constantly turning up, but the financial system has been artificially holding the valve down with paper contracts.
Precisely. But, paper contracts cannot build a solar panel.
Good point.
Eventually, the physical reality, the actual shortage of above-ground metal, overwhelms the paper illusion. The valve breaks.
So when that pressure valve finally snaps off, the release isn't going to be a polite hiss of steam. It's going to be an explosion.
Yes.
And that is what Oliver is predicting. I mean, silver is currently sitting around $68 to $69 on a pullback, having hit a low around $64 in February. But because of this 50-year buildup, he is projecting that it will rapidly reach $300 to $500 an ounce as it finds its new normal.
Which raises an important question.
Yeah.
If this setup is so explosive, and the mathematical precedents with copper and lead are so clear, why aren't more everyday investors positioned for it? Why do so many people end up losing money trying to trade silver?
Yeah, what is the psychological trap here?
The trap is distraction. Investors get entirely caught up in short-term metrics. They look at the daily fluctuations in Chinese supply and demand, or they obsess over COMEX open interest reports.
Wait, before we go further, you just mentioned COMEX open interest. For someone listening right now who doesn't trade futures, what exactly is that and why is it distracting people?
Oh, of course. So COMEX is the primary exchange where these paper silver contracts are traded. Open interest just refers to the total number of outstanding derivative contracts that haven't been settled yet.
Okay, got it.
Day traders obsess over whether that number is going up or down to guess what the price will do tomorrow. It's highly technical, incredibly noisy, and for a long-term investor, entirely irrelevant.
So they're looking at the daily weather while completely ignoring the shifting climate.
Exactly. The fundamental reality living underneath all that noise is the unstoppable math of sovereign debt and currency debasement. When a market is violently breaking out of a 50-year confinement, short-term data points just get flushed away by the macro current.
But that noise is terrifying if you are an average investor. Which brings us to the most actionable part of this analysis, really how to actually survive the volatility.
Right.
The source talks about the sharp price break we saw in January and February. For a day and a half, silver and gold prices absolutely tanked. If you were sitting at home watching the daily charts, you probably panicked.
Oh, absolutely.
But Oliver describes that drop as just a crack in the intermediate trend factors. He actually called it a cracked knee bone.
It is a very deliberate and illustrative phrase.
But how do you, the listener managing your own retirement account, tell the difference between standard market noise and a truly broken, fatal trend? Unpack this cracked knee bone concept for us.
Well, think about the physical mechanics of the human body.
Right.
If you crack your knee bone, does it hurt? Yes, immensely. Does it stop you from running your race tomorrow? Absolutely.
Right.
But is it a fatal injury? Are you dying?
No.
No, it is an intermediate setback. And how does the body heal a cracked knee?
You rest. You stay off it.
You stay off it. You don't move forward for a while.
Yeah.
In financial markets, the healing process for a cracked intermediate trend is sideways price action.
Oh, interesting.
Yeah, the price might bounce up and down locally, but generally it moves horizontally. And that is exactly what the data shows silver doing right now. Right. 6 months after that frightening February drop to $64, silver is still holding above that low. It's just moving sideways, healing its intermediate trend. Gold did something very similar, dropped a bit below its low, but engaged in the exact same sideways healing process.
Here's where it gets really interesting, because the way you measure the actual health of the long-term trend isn't by looking at the daily price chart at all. Oliver uses an oscillator that measures monthly action against a 36-month moving average.
Yeah, it's a powerful tool.
Now, before we lose anyone, explain how an oscillator actually works and why a 36-month average is the secret weapon here.
An oscillator is essentially a visual tool that smooths out the chaotic daily price swings to show you the underlying momentum. Imagine drawing a line that represents the average price of silver over the last 3 years. That's the 36-month average.
Okay.
The oscillator just measures how far the current price is stretching above or below that 3-year baseline.
So it filters out the panic of a Tuesday afternoon drop.
Exactly. When you look at that slow-moving structural metric, the long-term uptrend hasn't broken even a fraction of an inch. It is perfectly intact.
That's reassuring.
Zooming out to this perspective is the ultimate superpower for an investor. If you look at silver and gold since 2015 on this scale, the trajectory is undeniably upward. Yes, silver is far more erratic than gold. It's a highly volatile asset.
For sure.
But the structural bias is relentlessly upward.
But human psychology fights that logic every step of the way, doesn't it?
Oh.
We see a 15% drop on our screen, the flight or fight response kicks in, and we hit the sell button.
And then you are faced with a new, often worse problem. When do you get back in?
Right.
The source notes that retail investors who panic sell during these intermediate cracked knee bones almost always end up having to buy back into the market at a higher price than where they sold.
Ouch.
Yeah, they let the noise scare them out, they lock in a loss, and then they pay a premium to rejoin the structural trend they never should have abandoned. True wealth preservation requires anchoring yourself to the math, not the emotion.
Oh.
You have to ignore the daily headlines and focus on the irreversible growth of sovereign debt and the necessary printing of currency.
So what does this all mean? Let's bring this right back to you, the listener. We started this deep dive talking about hidden cracks in the system.
The marathon runner.
Right. What we've uncovered is a financial X-ray that tells a drastically different story than the mainstream news. The banking sector, the circulatory system of our economy, is flashing structural warning signs identical to 2007.
Yep.
But this time, the pressure isn't from bad mortgages. It is coming from a global sovereign debt crisis that is forcing central banks into a corner where their only escape mechanism is printing more money.
And as that currency is systematically debased, the pressure valve on silver is finally snapping. It is rejecting its 50-year confinement and shifting back from just an industrial component to a true monetary metal, following gold's lead to reprice the decaying dollar.
This isn't just abstract financial theory. This fundamentally changes how you should view the numbers sitting in your savings account. It is a stark reminder that the true goal of investing isn't just chasing nominal stock market highs on a screen.
No, not at all.
The goal is preserving your actual purchasing power in a world where the measuring stick itself is shrinking.
And I want to leave you with a thought that builds on the reality of this breakout.
Let's hear it.
We talked about how industrial metals like copper and lead completely redefine their normal prices, quadrupling almost overnight without making front-page news. But silver is unique. Silver isn't just a monetary asset. It is the highly conductive heartbeat of our modern technological life.
It really is.
It is irreplaceable in green energy infrastructure, in advanced computing, in the electrification of the grid.
It's quite literally the physical bridge to the future.
So here's the question you have to ponder. If silver, this 50-year pressure valve, finally explodes and rapidly establishes a new reality of $300 to $500 an ounce, what happens to the cost of our everyday world?
Oh.
If the raw materials inside the smartphone you are holding right now, or the solar panels required to power your city's grid, suddenly cost 4 to 5 times as much, how will that staggering hidden cost ripple through the global economy tomorrow? When the financial X-ray finally shows the break to everyone, how much will the cast cost?
Wow, that completely changes the picture. We are looking at a repricing of the future itself. Thank you for joining us on this deep dive. See you next time.